Well, as tensions continue to rise between Russia and Ukraine, oil markets continue to go for a ride. The latest action in markets showing crude oil tumbling, at least on this Monday. You can see a WTI down $8, Brent crude oil down $8 as well. Again, we had seen that pretty roaring increase as of the beginning of the conflict, but now that volatility continuing. So joining us now to break all of this down is Mike McGlone, Bloomberg Intelligence commodity strategist. Mike, it's great to have you on the show. You know, we had many oil guests on our program before the Russia-Ukraine conflict say, look, there are already secular trends that would maybe take a barrel of oil up to $120, maybe $130. So does that mean that the decline that we're seeing today is kind of something out of the norm here? How are you kind of parsing through the market action we're seeing?
Well, you need a good contrarian once in a while, Brian. I didn't agree with that narrative before. I fully expect crude oil is going to go back towards $40 or $50 a barrel, which is still well above the U.S. cost of production. And that's not profound at all based on how stretched prices were. So just a couple weeks ago, prices were the most extended above a 60-month average or a 100-week average ever on a future scale. The only similar examples were 1990, the Gulf War. I was in the trading pits then, I remember it well, and 2008. And every single time you correct about 60 to 70% in a few months based on one key factor, demand destruction. And I see supply and demand issues worse now than they were then. The key issue is now the U.S. is the net exporter, with Canada a massive exporter. And from this war, I think we're going to see a significant amount of demand destruction. So market price for supply contraction, I think it's not going to get that because all that Russian supply is going to China. They made an agreement, and now it's seen the beginning of recessionary issues that Michael Darda touched on earlier in the previous segment.
Yeah, no, I like looping in the universe of Mike's into that commentary there. But I guess just to kind of take the macro picture, right? There's this whole conversation right now about how inflation is underscoring how strong demand is. So when you say demand destruction, what are you talking about? Are you talking about the fact that China, for example, going offline because of their zero COVID policy is going to impact that? What's the basis for that?
Well, we'll start with China. Incremental demand in the world for crude oil imports is coming from China. China's in a secular decline. It's having a real estate crisis like the U.S. in 2008. What you saw today, revisions lowers in China GDP. I fully expect that. And don't underestimate the higher price cure. It always happens to commodities, particularly crude oil. Prices go up, squashes demand. Prices go down, increases supply. I fully expect that. That's not profound. That's what's happened in the past. So China demand in decline. Total crude oil imports from China around 7 million barrels a day, probably peaked a year ago. Now they have problems and they have to go to source a lot of it from Russia. Then let's look at supply. The massive amount of supply, most supply that's really pressured prices in the last decade has been from North America, i.e. U.S. shale. The average cost on my screens for U.S. shale is below $40 a barrel. So expect that massive supply. And I say North America because Canada too, my data in the term shows this year with this prices up, that surplus of supply versus demand liquid fuels, I have to include liquid fuels because of biofuels, ethanol, will approach 20% in this country. Why? We're going to squash demand and increase supply because of prices. That's a key thing then commodities that you're seeing. Those higher prices are the cure, and it's just starting to kick in crude oil.
Let's pivot over to metals. Supply and demand, very much a story there. Geopolitical headlines also weighing on, for example, nickel, where we saw a short seller out of China really get squeezed last week. Look, aluminum, nickel, palladium, all on the move. What are you seeing in the metals space? What's catching your attention?
Key thing right there, Brian, is those are primary exports from Russia. They're all going to be shut down. Aluminum's a problem. Aluminum was rallying before because of Chinese electricity production problems earlier in the year. But the key focus is nickel's probably peaked. Palladium's probably peaked. Remember, it's a significant substitute in platinum, which is half the price. It can do almost the exact same thing. It's half the price. And then the key metal to really watch in industrial metals is copper. Dr. Copper, the metal they say has a PhD in economics. It's basically almost down in the year now. It can't get above that $10,000 a ton resistance level, which is the same price as almost 12 years ago. What does that mean? That we're bumping up against good resistance in copper, the metal that really matters. And once crude oil peaks, which I think it has, those key macroeconomic commodities on the planet, crude oil and copper, I fully expect to revert much lower this year. By the end of this year, they should be much lower based on that demand destruction, based on the higher price cure. And the one metal I expect to be higher is probably gold, because it looks like we're heading towards a recession.
I mean, Mike, this is a really interesting point that you bring up because what happens to one metal spills over into others as well. How much of that is just because of the fact that liquidity in those markets is very different than, say, in equity markets? I mean, when you look at a move like we saw in nickel, hundreds of thousands of dollars of price movement. I mean, is that concerning? Are you worried about the way that the London Metal Exchange or that the markets are set up, given the ability to have that kind of volatility where you have an entire exchange saying, you know what, we're actually going to cancel orders that were already put in?
Well, it's a lesson I learned in the trading pits. I have my trading coat on here from the Chicago Board of Trade days in the 80s and 90s. And there was one key short nickel. And yes, they're very much less liquid than the equity market. But those big spikes are indicative of what happened. We had a significant event with Russia invading Ukraine. That was very unusual. Now they're past the initial shock and all. We're getting into realization that, okay, we're going to cut back supply. But the key supply that really matters from Russia is fertilizer. I mean, let's look at Brazil. They import 80% of their fertilizer from Russia. That means enduring prices for ag. But the metals, they'll come right back. We'll figure that out. The more macroeconomic sensitive, crude oil, all that supply from Russia is just going to go to China. It'll probably go right back down. So I'm more worried in the commodities of the fertilizer reducing global yields and people in the ability to eat. But the bottom line from all this, Brian, is North America commodity producers, Corn Belt, shale, liquefied natural gas will crush it in this environment. The profits should be sustainable. It should last a while, and that'll bring on that more supply. It'll just take a little while.
Mike, does the color say anything about your position? That did you pick purple for a reason? Give our Gen Zers who don't know about the trading pits an explanation here.
Well, I didn't pick purple, but I moved to Miami in September from the New York office, and I pulled this out of a box, and I found it was just the color of the firm I used to work for. And I like the lapels, and it just kind of brings me back to those trading days. So I like to kind of banter about it, but it really makes me remember of being I was in the pits in 1991 when Saddam Hussein invaded Kuwait. Maybe we're getting caught off a little bit side like then, but crude oil went from 20 to 40 and then right back down to 20 after it was resolved. I fully expect that this year. But the big difference is that back then, the U.S. is a major net importer. Now we're one of the most significant producers of energy on the planet, a net exporter, producers of agriculture on the planet. We have the dollar. So what's happening now, I think you're going to see a major depression, a recession in Europe, led by a collapse of the Russian economy, which is obviously a problem for those commodities, but a major boom for the U.S. in terms of once we get past this recession, but for those commodity producers. And that's good for the dollar, which overall, when you have strength in the dollar, means pressure on commodities.
Right. That jacket has certainly seen a lot. We just like that you're wearing purple because that's the color of Yahoo. But Mike McGlone, Bloomberg Intelligence commodity strategist, thanks again for stopping by this morning. Appreciate it.